Sean, are trusts just for the wealthy, or can they benefit me too? Sean, what's the difference between these trust structures? Sean, how can a trust help me protect my assets? What are the tax implications of setting up a trust? How do I know which trust is right for my situation? With the cost of living soaring and financial uncertainty in the air, more and more Australians are diving deep into financial research, looking for ways to better structure their affairs. There's a whole menu of structuring options, each tailored for different needs. Today, the two dishes on this menu are family trust and unit trust. Let's look at how they compare. Imagine a pie. In a unit trust, this pie is divided into slices and units. The more units you have, the bigger your slice. It's like owning shares in a company. Each unit holder gets a benefit based on their number of units. Sounds simple enough, right? Not really. There's a lot to consider. How is the value of each unit determined? Is it based on the initial investment, the current market value, or some other criteria? The value of each unit is based on the unit trust register and the trust deed. If there is a buyer for the units, then it will be based on the market value at which the buyer is willing to purchase those units. If not, read the trust deed. How are the profits distributed among unit holders? Is it always proportional to the number of units held? Yes, it will be normally proportional to the number of units held. Do all unit holders have equal say in decision making? Or do some units carry more weight? Controllership differs in each trust. Read the trust deed, as it is a rulebook that states who controls the trust. How are earnings from a trust taxed? Are there benefits to holding units long-term versus short-term? Earnings from a unit trust are treated as trust distributions. The treatment of the distribution will be dependent on the type of income that the trust incurs. For example, if it is ordinary income or capital gains. Speak to your accountant about this. Next, let's talk about the advantages to using a unit trust. Beneficiaries handle the tax based on their trust profits, and there's a potential for 50% capital gains tax discount if the asset sold within the trust is held for more than a year. Assets within the unit trust are protected as if it is a separate legal entity if it has a corporate trustee. Unit trusts also have more beneficial land tax treatment in certain states like New South Wales as compared to discretionary family trust. There are also a few downsides. First up, the potential loss of control. Imagine handing over the keys to your car to someone else and then just sitting in the back seat. Now that's how some unit holders might feel. Since they do not have the legal rights over the assets within the trust, they're essentially in the passenger seat, with the controller of the trust just driving in the driver's seat. The main decision maker might take turns and choose routes that the beneficiaries aren't too thrilled about. And if that person's decisions lead to a financial fender bender, well, the beneficiaries might feel the impact without having much say in the matter. Sure, there are legal avenues to challenge a trustee's decisions if they breach their trustee duties. But let's be real here. It's a path filled with potential legal potholes. Next on the list, cost. Setting up a unit trust can be a pricey affair. In fact, it is traditionally more expensive to set up a unit trust than it is to set up a sole trader or even a company. Also, unit trusts do not have access to that sweet 25% flat tax rate that a base rate company has. If their income revs up past a certain point, they could end up paying more in taxes. So while unit trusts offer some sweet advantages, it's essential to weigh them against these challenges. It's all about finding the right balance in your financial journey. Next up, switching gears to a family trust. Think of it like a family potluck dinner. Everybody brings something to the table, but there's one person, maybe grandma or Uncle Bob, who decides how the dishes are shared out. In a family trust, it is usually the trustee who plays that role as a controller of the trust, determining how the income gets distributed to the beneficiaries. Now, if you've been hearing the talk around town, you might have noticed that family trusts are often spoken about in financial circles. Why? Well, they've earned their popularity badge for a reason. Family trusts offer a unique blend of flexibility and protection, making them a top pick for many Australians looking to manage their wealth. Some of the advantages of this structure includes asset protection. Like with a unit trust, the assets in a trust are not owned by the beneficiaries. So the separation provides asset protection. Tax planning opportunities. A trustee can make income allocation based on the distinct tax circumstances of each family member. For example, if my son Edwin, who works part-time at McDonald's, have a lower marginal tax rate, I will be able to distribute more income to him so that he can pay taxes at a lower tax rate if it is within ordinary family or commercial dealings. By splitting the income tax allocation, the trustee can effectively minimize the general tax obligations of the family members who benefit from the trust. And lastly, the flexibility to distribute income as they see fit. The trustee can exercise its discretion when it comes to distribution of income and capital amongst family group beneficiaries. Family trusts can be beneficial for protecting vulnerable family members who may make rash spending decisions. A trustee could prevent a beneficiary who has a large gambling addiction, for example, from accessing a large capital amount that could quickly and poorly be spent. Many families could also use family trusts as a method of succession planning by giving more access to capital when children become older. This could help support their studies or help them buy their new house, for example. And again, like with unit trusts, establishing a family trust is not without certain risk. Firstly, you would not be the legal owner. Secondly, you will need to consider the costs involved in meeting the trust administrative requirements such as annual bookkeeping and accounting. Thirdly, undistributed income earned by the trust could be taxed at the highest marginal tax rate. And distributions to minors can be taxed up to 66%. Lastly, in some states, owning properties through a family trust means that your property may not be eligible for the land tax-free threshold. Now, the multi-million-dollar question, which trust should I choose? Well, it boils down to your individual needs and goals. If you're after the flexibility and want to actively manage how benefits are distributed, choose a family trust. But if you're leaning more towards a structured distribution where everyone knows their share upfront, a unit trust would be the way to go. That's it from me, and hey, if you ever feel lost in the financial maze, don't hesitate to reach out for guidance. Keep it up, you're doing really well.